$75,000 in tax-free HSA death benefits to your heirs, except the IRS rule that permits it has a limit most miss. If you've heard this strategy from a tax pro, or you're considering using your HSA as an estate planning tool, the next 4 minutes will show you exactly where that $75K promise falls apart under IRC 223B. And by the end, you'll know the correct way to structure this, or whether to skip it entirely. You're watching Tax Shield Research Team. This is educational analysis of IRS code sections and Treasury regulations, not personal financial advice. Consult a licensed tax professional before implementing any strategy. Rehook before we expose the flaw. Let's start with the wrong belief that's circulating right now. Here's the pitch. You can fund an HSA to the annual maximum, $4, $150 for self-only coverage, or $8, $300 for family coverage in 2024, and invest that money directly into a life insurance policy inside the HSA. Let it compound for 20, 30, or 40 years. When you die, your heirs inherit the full death benefit completely tax-free under IRC 223B, potentially $75,000, $150,000 or more, with zero income tax on top. No estate tax, no income tax. It's positioned as the perfect wealth transfer loophole for high-income earners. That sounds bulletproof, but here's where it collapses. Rehook. The IRS code that allows HSAs to hold life insurance has a critical limitation that most advisors either miss or deliberately obscure. Here's the correct reality. IRC Section 223B does permit HSAs to include life insurance as a permitted investment. That part is true, but and this is the entire game changer. The death benefit tax rule in 223B only exempts the accumulated HSA balance from income tax. It does not exempt the life insurance proceeds. Life insurance inside an HSA is treated as a non-qualified investment. When the account holder dies, the death proceeds are subject to ordinary income tax in the decedent's final tax return. For a high-income earner in the 24% tax bracket, that's $18,000 in taxes on a $75,000 death benefit. For someone in the 32% bracket, that's $24,000. For those hitting 37%, that's $27,750 gone to the IRS before your heirs see a dime. The net inheritance shrinks by nearly 1/3. Rehook. But wait, there's a second limit that makes this even worse. The $4, $150 annual contribution cap in 2024 still applies, no exceptions. You cannot contribute more than that to an individual HSA, regardless of what investment vehicle you choose inside it. So let's do the math. If you max fund a self-only HSA for 20 years at $4, $150 per year, that's $83,000 in contributions alone. A married couple maxing joint HSAs at $8, $300 annually accumulates $166,000 over 20 years before any investment returns. But here's the realistic part. Accounting for market volatility, average fee drag, and conservative assumptions, that $83,000 grows to maybe $100,000 to $120,000 for an individual over 20 years. For a couple, you're looking at $200,000 to $240,000 at best. Now compare that to the promise, $75,000 per spouse, $150,000 plus tax-free per household. The narrative collapses. The claim promises $75,000 plus. The reality limits the tax-free portion to your actual HSA balance, maybe $100K, $120K for an individual, and then applies a 24% to 37% income tax hit to the life insurance death proceeds on top of that. Rehook. Here's what makes this dangerous right now. IRS enforcement actions on HSA misuse jumped 32% in 2023 and 2024. Audit exposure increases dramatically when you structure HSAs outside the qualified medical expense framework. If the IRS determines that a life insurance investment in an HSA was not a permitted use, or that it was structured with intent to evade tax, the agency can recapture years of deductions, apply the 20% accuracy-related penalty, and charge interest retroactively. For a household that funded an HSA aggressively for 10 years, that penalty can exceed 6 figures. You're looking at $50,000 to $200,000 in back taxes, penalties, and interest. So what should a high-income professional actually do instead? First, use your HSA for what it was designed for, paying qualified medical expenses tax-free. It's the best tax vehicle in the code. Don't overcomplicate it. Second, if you want to leave a tax-free inheritance, a traditional life insurance policy purchased outside the HSA, combined with a step-up basis on your estate at death, is a cleaner, more defensible strategy under current law. Third, if you're already holding life insurance inside an HSA, document that decision carefully and understand that the death benefit will be taxable income to your estate. Fourth, before implementing any HSA as estate planning strategy, consult a licensed tax advisor or CPA. The tax code rewards those who study it carefully, but it punishes those who misread it.